At MTA, we specialize in making accounting simple and understandable so you can focus on your business goals.
All right, today we're tackling something that trips up so many UK company directors, the director's loan. It sounds simple enough, right? Borrowing from your own company? But honestly, it's riddled with tax traps that can cost your business thousands. We're going to break down exactly how to handle it correctly, with some expert guidance from the specialists over at My Tax Accountant. Let's get right into it. I mean, who hasn't been in this situation, right? You're out, maybe grabbing lunch or buying something online, and the company card is just right there. It feels totally harmless. It's just a little IOU to your own business. You'll sort it out later. But that one seemingly innocent swipe can actually open a whole Pandora's box of tax complications if you're not careful. So, to really get our heads around this, let's look at a real-world example. Let's meet Ben. His marketing agency is doing great, and he needs a quick, short-term loan for a house deposit. Using the company's cash seems like the fastest, easiest way to do it. But what Ben doesn't realize is that this £20,000 loan has just put his company on a direct collision course with HMRC. Okay, so here's what we're going to cover in this explainer. We'll start with that common mistake. Then we'll dive into the critical 9-month tax trap you need to know about. We'll debunk the myth of just writing off the loan. Then we'll look at HMRC's very specific rules designed to stop you from gaming the system. After that, we'll talk about the smart way forward. And we'll finish up with a simple checklist to keep you on the straight and narrow. All right, let's kick things off with Section 1, a director's common mistake. We're going to break down this seemingly innocent loan and how it's all officially recorded. First things first, what are we actually talking about here? Well, every single time a director borrows money from or even lends money to their company, it has to be recorded in something called a director's loan account, or DLA. You can basically think of it as an official running tab between you and your business. It's not your salary, it's not a dividend, and it's not you getting paid back for expenses. It's a completely separate ledger, and believe me, HMRC watches it very, very closely. Okay, moving on to Section 2, and this is where things start to get really serious. We're about to run into the first major hurdle, a very specific and potentially very costly tax charge called Section 455 corporation tax. So what on earth is this Section 455 tax? Well, its purpose is actually pretty simple. HMRC created it to stop directors from treating their company like a personal tax-free cash machine. It's a really powerful deterrent. And the crucial thing to know is that it's a tax on the company, not on you personally. Well, at least for now. And here it is, the number that should really make you sit up and pay attention. A whopping 33.75%. Now, this rate isn't just plucked out of thin air. HMRC very deliberately set it to be the exact same as the higher rate of dividend tax. The message they're sending is crystal clear. You can't get around tax just by calling your money a loan instead of a dividend. Okay, so how do you dodge this bullet? Well, you've got to follow a really strict deadline. The moment your company's financial year ends, a clock starts ticking. From that day, you have exactly 9 months and 1 day to repay that loan in full. If you miss that deadline by even a single day, the tax is due. Right, let's bring it back to Ben's situation. He borrowed that £20,000. If he doesn't manage to pay it back in time, it's his company that gets slammed with the tax bill. A quick bit of maths, 33.75% of £20,000 is £6,750. That is a massive and probably unexpected hit to the company's cash flow that has to be paid straight to HMRC. Now, here's a detail that a lot of people miss. This tax, it is temporary. You can get it back. But, and this is a huge but, the refund isn't instant. You can only claim that money back 9 months after the end of the accounting year in which you finally repaid the loan. This means your company's cash could be locked up with HMRC for well over a year. Sometimes it's even closer to 2. So it's less like a tax and more like a very severe cash flow punishment. All right, Section 3. Now, if you're facing a nearly £7,000 tax bill for your company, you might be thinking, hey, I've got an idea. I'll just get the company to write the loan off. Sounds neat, right? It seems like a clean solution. But it's just an illusion. You're not actually solving the problem, you're just creating a brand new one for yourself. So let's break this down. For the company, it looks brilliant, right? The loan is gone from the books, the Section 455 tax liability disappears with it. Fantastic. But for you, the director, a brand new personal problem has just landed on your doorstep. HMRC now reclassifies that entire £20,000 write-off. They see it as a distribution of company profit, which basically means it's treated like a dividend paid directly to you. And this is the absolute kicker. The tax bill, it hasn't disappeared. It's just jumped ship from the company's books right onto your personal self-assessment tax return. So assuming Ben is a high-rate taxpayer, he now personally owes dividend tax on that £20,000. And what's the tax rate? You've probably guessed it, 33.75%. The bill is the exact same £6,750. You've achieved absolutely nothing except moving a debt from one place to another. Okay, section 4. So you might be thinking, all right, I'll just be a bit clever about this. What if you repay the loan just in time and then, just borrow it again a few days later? Well, let me tell you, HMRC is already 10 steps ahead of you. They have very specific rules to stop people from trying to game the system. They have something specifically for this, called the 30-day rule, and it targets a practice that's often called bed and breakfasting. The rule itself is quite straightforward. If you repay £5,000 or more, but then you take out another loan of £5,000 or more within the next 30 days, HMRC will just disregard the repayment for tax purposes. They'll link the new loan to the old one, and that tax charge will still apply. Let's watch this play out with Ben. He pulls together the 20 grand, pays it back just before the deadline. Whew, tax avoided. But then, just 2 weeks later, he takes that same 20 grand back out. And that's when the trap springs. Because the repayment and the new loan were both over 5 grand and happened within 30 days of each other, HMRC's rule kicks in. The repayment is essentially canceled out by the new borrowing, which means the original loan is still considered outstanding. That $6,750 tax bill, it's back. Right, section 5. We've talked a lot about the traps and the pitfalls, so now let's talk about the right way to do this. What are the smart, compliant ways forward? And here's a brilliant professional tip straight from the team at My Tax Accountant. If your loan goes over £10,000, HMRC can decide it's a benefit in kind of like having a company car, and they can tax you personally on it. The way to avoid this extra tax charge is actually quite simple. The company just has to charge you interest on the loan at or above HMRC's official rate. So let's get down to it. What are the totally clean, above-board ways to clear that loan? You've really got 3 main routes. First and simplest is to repay it from your own personal post-tax savings. Second, your company can declare a lawful dividend to you as long as it has enough retained profits to do so. That dividend payment then clears your loan balance. And third, the company can pay you a bonus through the payroll. Now that will be subject to PAYE and national insurance, but it's another perfectly legitimate way to settle the debt. Okay, last section. We've gone through a lot of detail here, so let's boil it all down into a super simple checklist for you to take away. So here it is, your director's loan checklist. Number 1, that 9-month and 1-day deadline is absolutely non-negotiable. 2, remember, writing off a loan doesn't make the tax go away, it just makes it your personal problem. 3, don't even think about tricking the system with that bed and breakfasting tactic. 4, keep meticulous records, they're your best defense. 5, for any loan over 10 grand, make sure you're charging interest. And finally, and honestly, this is the most important one, this is complicated stuff. Before you borrow any significant sum, please talk to a professional. And just before we wrap up, a very important disclaimer. The information and the scenarios we've talked about today are for general guidance only. This does not constitute professional tax advice. Everyone's situation is unique, so you really must consult with a qualified advisor for your specific circumstances. Look, if you're a director and any of this sounds familiar, please don't leave it to chance. The rules are complex, but with the right guidance, the solutions can be quite straightforward. Get in touch with the experts at My Tax Accountant for clear, professional advice that's tailored to you. You can call them on 0208-570-8531 or email info@mytaxaccountant.co.uk. And for more explainers like this one that simplify complex business topics, make sure you subscribe to the channel. Thanks so much for watching.